In a previous video, I answered the question, do I need an LLC for my investment property? And we looked at why the answer to that question is yes. In this video, I'm going to address the question of, for a person who owns more than one investment property, how many LLCs do you need? So, as we previously discussed in the last video, you absolutely should own an investment property through an LLC, which is the most simple and easiest to maintain form of limited liability entity. But a corporation can also work, or other limited liability entities. But now let's take our hypothetical investment property owner who already owns one property through an LLC, and let's assume that she wants to buy a second property. The first investment property has gone so well, she sees an opportunity to buy another investment property, wants to increase her income, and she wants to jump on it. So one possibility would be that she can buy the second investment property through the same LLC that she's already formed and that already owns the first property, in which case her business structure is going to look like this. She owns one LLC, the one LLC owns two properties. This still is going to give her the benefit of personal asset protection, where liabilities arising in connection with her investment property business will not put her personal assets at stake. However, in this structure, note that if there is a liability that arises in connection with property one, that claimant, the person who might sue, is going to sue the LLC, and in property two is also an asset of this LLC. So by holding both properties in the same LLC, she is putting both properties at risk in relation to liabilities that arise just in connection with only one of the properties. So an alternative would be she could form a second LLC to purchase and own the second property. Now, if there's a liability arising in connection with property one, only LLC one is going to be sued, and so only property one and the bank account of LLC one are going to be put at risk, and property two is going to be safe. Again, this is assuming she's observing basic LLC ownership formalities. Vice versa, if there's liability in connection with property two, property one is going to be safe. She was only putting property two at risk and the bank account of LLC two as recourse for claims arising in connection with property two. Now, some clients I have will say, I understand that there's more protection by forming separate LLCs, but I don't want to have to deal with multiple operating agreements, multiple annual reports and filings with the state, and I'm willing to take the risk of putting multiple properties in the same LLC just for administrative efficiency and simplicity. And that's fine. That's the client's choice, as long as they're aware of the risks of that and they are, wanting to keep things simple and willing to put their properties at a little bit greater risk in order to do so. That's fine. And as always, hopefully insurance is going to be the first line of defense with any of these liabilities. So hopefully, it's not getting to the point where you need that liability protection. But for the maximum protection, this is the optimal structure with multiple LLCs, a separate LLC for each property. Now, let's assume that our investor already owns two properties. She has formed two LLCs in order to purchase them. And now she wants to take on a partner. Now, what is the structure that makes sense? Well, if we go back to this before she has a partner, where she is the sole owner of LLC 1 and LLC 2, in this scenario, when an LLC has only one owner, the LLC can be disregarded for income tax purposes. What that means is that she does not need to file a separate tax return for each of these LLCs. She can report the net income or net loss of the LLCs on her own personal tax return. So from a tax accounting perspective, there's not a lot of additional cost to having separate LLCs for each property. However, in this scenario, if her partner were to own an interest with her in LLC 1 and LLC 2, then these LLCs are no longer owned by a single owner. They now each have two owners, which means that they cannot be disregarded for income tax purposes. They would have to file, each of them would have to file a partnership tax return. So this structure does add some accounting cost to accommodate separate LLCs for each property. Additionally, we talked previously in our last video about how these two should have a good operating agreement, or in other words, a partnership agreement that governs the terms on which they're partnering in these investments. If we have two LLCs, now they're going to have two operating agreements, whereas if it was a single LLC, they could have only one operating agreement. So there's additional legal costs in the structure as well. But what do we do if they want the maximum liability protection, but don't want to add that additional accounting and legal costs? Is we can add a holding company to the structure. So now LLC 1 has only one member, holding company. So LLC 1 can be disregarded for income tax purposes. LLC 2 only has one member, or one owner, holding company. So LLC 2 can also be disregarded for income tax purposes. So neither LLC 1 nor LLC 2 has to file its own tax return. Holding company has two owners, so holding company will have to file a partnership tax return, but we're only having to file one tax return, even though we have separate LLCs that own the property. So here we have the best of both worlds. We have liability protection, where property 2 is safe from liabilities of property 1 and vice versa. We have a single tax return that needs to be filed for a holding company. Holding company will need a good comprehensive operating agreement that sets forth the terms of the partnership in their ownership of these properties. But LLC 1 and LLC 2 can have very simple operating agreements because all the key terms are up at the holding company level. So this is a great structure that provides maximum liability protection and asset protection, while also simplifying legal and accounting requirements and reducing those costs. And so this is a really good structure for partners who are going to own multiple properties together. Note, however, that this works best if the terms of the partnership, the percentage breakdown, the decision-making is going to be the same with respect to each property. If they're going to be 50-50 owners for property 1, but 75-25 for property 2, this structure may not work, or it may need to be tweaked with a little bit more complexity. So there you have it in terms of how many LLCs you need for your investment properties. There's various options here, and what's best for you is going to be subject to your personal risk tolerance and ability to handle a little bit more of a complex structure. But in any, as with all things legal, there's no one-size-fits-all solution. So you should always be making these decisions in consultation with your attorney, your accountant, and your other legal advisors. Hopefully this video has been helpful.